This is past economic growth of, on average, real GDP growth per year, 10% over 30 years. And I'm asking, how long is it going to continue? And if it continues, what are the implications? So I do three things first. I extrapolate this past growth and just show what that means. And extrapolations are not explanations. So beyond extrapolations, how can I explain that these trends continue? What are potential reasons for these trends to continue? I come up with two very general approaches, and then I move on to implications. Extrapolating this past growth into the future leads to the following. We can start from today, 2010, with the estimated GDP values. The US is 2.6 times larger than China, so nothing to fear, nothing to worry about. China is really small. It's 1/3 the size of the US, as Clayton has pointed out already. But then if we move ahead in the future, look at line 1A, we just move ahead with the past growth rates. Chinese GDP will be the same size as that of the US by 2025. So that's still a long way ahead. It's 14 years ahead. Then we put in a 5% renminbi appreciation per year. It's 2018. So in 7 years' time, the Chinese economy will be as large as the US economy. Then we move another step ahead and we adjust for price differences. The Chinese price level is 42% that of the US. So a particular basket of goods and services that costs $1 in China costs $2.4 in the US. So if we make that adjustment, account for purchasing power parity, then China will be the same size as the US by 2012. That's line 2A. If we add in the renminbi appreciation, it's today. It's 2011. So in purchasing power parity terms, in the way the economy feels, China is as large as the US right now or tomorrow. Per capita, things take much longer. So China has 4 times more people than the US, so obviously it's a higher GDP. Per capita, if you look at the orange columns at the end, it takes much longer. The 5 fastest growing provinces on the far right, which have a population larger than the US population, they take until 2018, 2020 to have the same per capita income level in purchasing power parity terms. So it's this trend that says China is already as big as the US in purchasing power parity terms, in nominal terms in 7, 8 years per capita, in 10, 15, 20 years. Is this trend going to continue or not? I take 2 basic development patterns. I'm not controlling for anything. I just keep it very simple and point out two items. One is output. We can decompose output into 2 components. One is output per worker, and the other one is times the number of workers. Now, the number of workers is not going to increase anymore, as Barry has already pointed out. By 2014, the labor force is going to peak, and right now it's not growing anymore, just a tiny bit. So output per worker is increasing a lot, and we can decompose that into 2 parts. One is across the economy, output per worker increases, or we can, in the second item, we can decompose that into people shift from low productivity sectors into high productivity sectors. So that means moving out of agriculture. And if you look at the chart, the blue line at the bottom, that's output per worker in agriculture. The purple one on top, that's secondary sector, industry and construction. Every time you move a worker out of farming into industry, that person produces 7 times more output. And we can argue that maybe not many more people can be shifted out, but here's the effect. The minus 0.01 on the horizontal axis at the bottom means if we shift 1% of the labor force out of agriculture, for example, we reduce the share of employment in agriculture from 44 to 43%, then the corresponding growth rate is on this upper black line of about 8%. That's one point to look at. The other point is at the zero vertical axis. At the 0 point, Chinese growth is 5 to 6%. So in very broad terms, if China doesn't move anyone out of agriculture, it grows at 5 to 6% per year. That's the average labor productivity growth. That's how China is catching up with the West. And every time that it moves 1% of the labor force out of agriculture, on top of that, it gains another 3 or 4%. So the next question is, how long can that continue? China still has 38, 39% of the labor force in agriculture. Japan, Korea, Taiwan started out at similarly high levels, moved below 10%. Even if China never moves below 10%, even if it only moves to 20%, that's another 20 percentage points to move people out of agriculture. That process is not over. We can argue if it is slowing or not, and some people have done detailed studies, but in broad terms, the difference is still there. There's still a lot of scope to move people out of agriculture. The second point is this general growth of labor productivity. And the idea would be catching up. China is so far behind the technological frontier that it's easy to catch up. It's easy to imitate. But Japan came with high growth rates when it was at a very low development level. So 1.0 on the horizontal axis means the same level of output per worker as the US. If you're at 0.1, that means the output per worker is 10% that of the US. So if you look at Japan in the early years, 10%, 20% of the output level of the US per worker, high growth rates. On the vertical axis, the growth rates. And then gradually, as Japan approaches the income level of the US, growth slows down. Taiwan and Korea, they seem to start out along similar lines as Japan, but then somewhere around 50% of the income level of Japan or the US, they dropped off. Nothing more happened. That's this middle income trap that Barry mentioned. China is still so far on the left that it doesn't really fit into the picture yet. It's at the very beginning of this process of catching up. So on both accounts, on the shifting people out of agriculture, the structural change, and labor productivity growth, there's a long way to go. Another way to look at it is through an econometric analysis. Like, I won't go into many details. I'm going to bypass it with a very brief explanation and some data. A historical fact is that the labor share in GDP is relatively constant. Labor remuneration as a share of GDP tends to be constant across countries, and it is the case for China. It is relatively constant. Now, if we express labor remuneration as wage rate times labor, we decompose that labor remuneration, and then we have wage rate times labor divided by GDP is constant. We switch to growth rates. We get real GDP growth is real wage growth and labor growth. Now, how do I predict future real wage growth? How do I predict future labor growth? Now, let's start. What do we know about the future for China? We know the land isn't going to sink into the ocean. That's about the one thing that we can know for sure. But another thing we can know for sure is people don't disappear. We won't have millions of people die unless something very severe happens. We don't have millions of people appear. They're there. So if we use the 1982 population census, the 1990 population census, the 2000 population census, we can shift population over time. And we know in the year 2000, we know already the population size for the year 2015, the working age population size for the year 2015. Labor participation rates tend to be constant over time. A number of assumptions about birth rates, death rates, all tend to be rather stable over time. So we can actually reconstruct or construct forward the labor force by age cohort, by education, all the way through 2015, if not 2025, with very basic assumptions and very reliably. And that's what I did. So the labor growth for the future we know. How do we get the wage growth? Well, in microeconomics, we relate wages to education and some other things. So I do that at the national level using time series data. I relate wages to education for the past. I get a relationship, a stable relationship. I put in future education data. I get future real wages. I simply add up. That's a very simple approach. And I do much more in the research paper that I will not explain. Here are the co-integration equations. And look just at the last two columns. Out of this very simple model come these predicted growth rates. And let's look at 2010 through 2015. We have growth rates of about 8%. That is slightly less than has happened so far. For 2005, 2010, 9%, 8%, 7%. It's roughly in the ballpark. And that continues. So 2010, 15, 8%. 2015, 2020, between 6 and 11. That shows how weak the procedure is. But roughly the same growth rates as before, not a severe drop-off. And at these growth rates, Chinese GDP will be the same as that of the US by 2018 in nominal terms, apart from the fact that it's already the same in purchasing power terms. So out of the development patterns that I showed you in the charts, out of the econometrics comes a substantial argument that this growth is going to continue. That is not looking at inflation, that's not looking at short-term factors, that's just looking at the big items that push growth forward. One key item is human capital, is labor, this is education. The education that that has this very high impact in the prediction of the future wage rate. And I have a chart that's very similar to Barry's, looking at tertiary level graduates in China and the US. China has now more than twice as many tertiary level bachelor degree, associate degree graduates than the US every year. And that has not been the same in the past. That started in 1999. So there's something very new happening since 1999. And that is a very large number of Chinese students graduating from university, a number that's twice as large as the American number. If you look at the MA and PhD, the US still has twice the number, but at the MA and PhD level, how many students in the US are actually foreigners and might return to their countries? So this overall, this enormous number of educated people in China, and that will feed through in the labor force with a time lag. It's not happening today. The first people who are graduating are now 30 years old, 35, they're gradually moving up in companies. There's going to be much, much more because that education level is not going to fall. We have all of a sudden this drastic rise in education levels, and that is pushing the growth. What have we learned? We have learned that in terms of purchasing power, China is as large as the US today or next year. In nominal terms, it takes longer. Per capita, it takes 1 or 2 decades, but then we have a population the size of the US population in 10 years' time that is as rich as the American population. Implications, and here I move beyond the research. One implication that does not hold, this is President Hu's visit to the US recently, delighted to be in our country. Let me just dispel a couple of myths here. China does not own the US. It owns 10% of the US treasuries outstanding. Japan owns another 10%. In terms of FDI, if you look at the last column, 2009, US FDI into China was 2.6 billion. Chinese FDI into the US was 0.9 billion. The US is quite closed to FDI from China. Chinese FDI goes elsewhere because the US is relatively closed. And if you look at earlier years, there's very large US FDI into China compared to Chinese FDI into the US, just 10%. The Chinese FDI into the US is just 10% of US FDI into China. And whatever numbers you're looking at, it just doesn't hold. China does not own the US in any way. It's the other way around. It reminds me of the earlier China price argument, that China beats the world on everything in terms of price, takes over the world. It hasn't yet. The US trade deficit with China, and Barry brought that up too with the iPhone example, is exaggerated by at least 100%. By measuring revenues, export revenues instead of value added. So all these things that make China appear a threat don't hold. I'm going to raise 2 questions in the remaining 6-7 minutes. One is, where's China's steady state? Is there a middle income trap, like Korea and Taiwan seem to have experienced? Like Korea and Taiwan, China is undergoing this rapid structural change, moving people off the farm. The US had that 100 years ago. UK, Europe had that 150 years ago. China is just going through the regular pattern. And it is catching up. And because it was so far behind, it can leapfrog technologies across industries. There's a very strong advantage to being behind. You can just jump technologies. You don't need a fixed line telephone in rural areas that costs a lot of money to put in. You switch to cell phones right away. So that means rapid growth up front. Is it going to stop like Korea and Taiwan? The earlier pattern suggests no. The econometrics suggests no. Just thinking through what's different. What's different for China compared to Korea and Taiwan? Well, size. It's 1.5 times the population of the European Union plus the US plus Japan combined. Just size. That means a huge domestic market that allows a complete industrial structure with all the synergies of a complete industrial structure, that allows economies of scale, that means competition, that means pressure to innovate, firms competing. The human capital argument, if the US has 1 genius, China has 4 geniuses. If you think of a country owning the geniuses, and one of the 4 might be a super genius, but then that person might work in the US. So just the sheer size that allows much different operations than for Korea and Taiwan. The international bargaining power that was pioneered by MITI for Japan in the 1950s, bargaining on behalf of Chinese companies, the government bargaining on behalf of Japanese companies with foreign companies, and the Chinese are doing exactly the same in terms of technology transfer, bargaining very hard. And they have the size of the country to back it up. Everyone wants to be in China. I think China is a different superpower from the American superpower, and I have 4 points, and this moves beyond my research. I'm going to throw out some things here. In terms of endowments, there's one very clear, long-lasting difference. The US has a comparative advantage in agriculture. This might strike you as astonishing and not really relevant, but the US has 6 times more land per worker, per person, 6 times more land per person than China. And that's not going to go away. That's going to stay. That's the only thing that we can guarantee is going to stay in the long run. So like Australia has an advantage in mining, the US has an advantage in agriculture. And then you can continue and say the US also has an advantage in technology and skilled labor. But if you look at reports, it looks like that's being eroded already. One word of caution, Chinese firms cover a very broad spectrum. Within one sector, we have firms that seem to be operating at very close to the world technological frontier, and firms that are very backward. So when we look at the average, it's not great. But within each sector, we are finding firms that are very close to the international technological frontier. A second point, why it's a different superpower, a focus not on military but on economic power. The sentence by Zhu Feng at Beida strikes me as very revealing and very accurate. The establishment of Chinese bases overseas is a suicidal idea that will only galvanize opposition to China's rise. I think that's very accurate. China is not going to reach out militarily. Instead, it's going to be prepared to defend, to deny waters, Chinese waters and Chinese airspace to the US or any other nation. So we're going to have a military build-up, but it's not going to be aggressive going outward. It's going to be around China. For the US, it's just the opposite. The Asian nations call for the US to support them militarily. The US is the military power. The economic power of China we see all the way through East Asia, through Southeast Asia, through Central Asia, and there's just, I could list hundreds of points here, the pipelines into Kazakhstan, the railway lines into Laos, Burma, all across Southeast Asia. Just details that come up time and again in the news. The China Development Bank has teams in 149 countries. China is lending more to the third world than the World Bank by now. It goes back, if you want to go back to Mao Zedong's 10 major relationships, encircle the urban areas from the countryside. The US denies us our FDI. We can't invest in the US. We invest everywhere else. We take it from the outside. Another difference, a large element of foreign directedness, another difference in the way this superpower operates compared to the US. 30% of the Chinese economy is foreign-owned, and I think Barry brought that up before. Probably the best companies in China, the highest technology companies are foreign-owned. Our pensions depend on firms that operate in China. The more China grows, the better for our pensions. There is a very deep connection between countries that incorporates China. It's not nation against nation. And the last one is political implications of this economic power. And there, again, we see example after example. And it's not, we don't have WikiLeaks yet for China. We don't know yet how many threats are going on, but we get little insights here and there that this economic power is being used. For example, the first one, China halted exports of rare earths to Japan in fall 2010 after the Japanese Coast Guard arrested a Chinese fishing boat captain. So it's just item after item. We're going to bail out Greece for you in the Eurozone if you allow military exports to us. These things we don't see openly, we just hear about them. And that economic power translates into that political power. Thank you.